What's going on, my friends? It's your boy Chris over at VerrilloTrading. Today I'm coming to you live from the car. I'm going to go back to the office and record a video. This video is going to be pretty important. I'm going to talk to you guys about why I think Forex trading is generally not worth it for retail traders and why I think it's kind of a scam. So I'll see you in the next one. See you later. What's going on, traders? I'm back at the desk over here. I'm back at the office, and I wanted to do a little video for you guys today talking to you guys about Forex. Forex trading, because of course the number one topic on YouTube, the number one thing that new traders get caught into when they first get into trading, they're researching about trading, they learn about Forex. What's Forex trading? That's the term that gets thrown around a lot. Well, in this video, I'm going to explain to you why Forex, the foreign exchange marketplace, is one of the absolute worst marketplaces for retail investors to trade. And I believe that there's a negative edge built into retail Forex trading, and I'm going to explain to you why this is the case in this video. So by the end of this video, I should have convinced you that Forex trading for retail trading has a negative expectancy and you should avoid it at all costs. However, if I didn't convince you, please let me know down in the comments below. What I really want you to do is, if you get value from this video, press the like button and send it over to one of your friends who's learning about Forex trading to inform them about what they're really getting into, okay? So let's get started right now. Now, before I tell you what this is all about, I need to explain to you what the main problem with Forex is. And this problem is common across other asset classes too, but in Forex, this problem is much bigger than in all those other markets. And it's that the volume being transacted in the Forex market is not being transacted in one centralized location or one centralized exchange. This is an issue because you're not actually able to see all of the trades that are going through. Now, you don't probably need to see every single trade, but I'll give you a couple examples as we go on here, okay? Over here we have a bank. So the bank is basically a bank or broker or exchange. This is where the money is, okay? You have your big banks, your brokerage firms, or your exchanges, independent exchanges that handle the buying and selling of Forex. Just talking about Forex in this case, but this also applies to cryptocurrencies too and other types of markets. So the funds are being held over here with these institutions. They have access to this. They have access to liquidity. You're the retail customer. You want to trade on the exchange. But when you're trading on the exchange, you only have access to this liquidity when it comes to looking at how many traded and how many want to be trading. So I'll give you an example right now. Let's say you're trading on an exchange called, let's say, Oanda, one of these huge big Forex brokers. I have never used these platforms before, but I can probably take a very educated guess that when you trade on these platforms, they give you the order book. You see the order book of their particular exchange. You're seeing the exchange of Oanda or one of the exchanges you're trading with. With Interactive Brokers, here's an example that I actually know about. You have access to this order book right here for whichever currency pair. And what this order book is, it's not the centralized order book of all the Forex bids and offers in the entire world. It's Interactive Brokers' liquidity pool for this particular currency pair. And I am probably sure that either it's Interactive Brokers themselves or some other company that's associated with them, that they take care of the quoting of the bids and the offers, basically the market makers at the inside bid and offers. And it's sort of like an algorithm that provides these quotes. Okay. Now, as we go on with this, I know it's getting a little complex, but I'm trying to simplify it as much as possible. The first basic thing I want to get across here is that every single bank, broker, or exchange that deals with Forex broker dealers, they are providing the retail customers with access to their own liquidity pool and only their own liquidity pool, which means that when you're trading Forex on Interactive Brokers, you're not seeing the volume, the real-time volume, how many traded and how many want to trade on the order book. You're not seeing that for what's going on with Bank of America. You're not seeing it for what's going on Oanda, on IG, on all kinds of these other liquidity pools all around the world, of where millions, billions of dollars are being transacted every second, probably. You're not seeing any of that activity on the time and sales. What the time and sales is this, where you're seeing one trade come in on your screen after the next. So now I'll depict for you an example that I think everybody will be able to relate to. Let's say you have an orange juice market, and this is the market, this is the place where everybody goes to buy and sell orange juice, and there's no other place. This is the centralized location where it is very clear that people go to this place to trade orange juice. This is a marketplace. It could be electronic or it could be an in-the-person exchange, like on the floor. So a buyer shows up on the exchange and they say, I want to buy orange juice at a price of $9. And then I also want to buy it again at $8 and also again at $7. So they're going into the exchange and they're placing bids and they're bidding for the orange juice. At the same time, we have people that come to the orange juice and they are sellers. I want to offer to sell my orange juice today. I want to sell 100 gallons of it at $11. I want to sell another 100 gallons at $12. So this is your order book right here. When you look at a trading platform today, it's displayed like this, where you can see here the price, how many want to buy, how many want to sell, and how many bought and how many sold. In our orange juice market, that's also important information, which is how many sold and at what price and at what time did they sell at. Because this information right here, along with how many currently want to buy and how many currently want to sell, all of this information put together gives information about what the market is currently doing, where the market is currently valued, and where the market may likely move now or soon from now because of the information about the supply and the demand that is currently existing in the market. It's public information that everybody can see. So what goes on here, if there's only one orange juice market, it's very simple because you can just show up to that one market and you can see every single trade going through and you can see as many buyers and sellers as there are. There's no information that you're not seeing. So now that you understand that, let me give you an example of what the Forex market really is and why volume is not reliable. Because in the Forex market, there is a whole bunch of these different orange juice markets, each one with their own amount of buyers and their own amount of sellers and their own consolidated time and sales record of how many sold and how many bought. And if you truly wanted to see what is happening on all these orange juice markets, well, you're going to have to gain access to all that data and find a way to consolidate it into one readable human data feed, which probably exists, but most retail participants do not have the means or the understanding of how to accomplish that. On top of that, probably a lot of the largest amount of transactions going through are done here between like interbank transactions. So their own sort of hidden liquidity pools in Forex. And I'm pretty sure this goes down, which is one bank trading with another bank or banks offering to exchange currency for customers between banks and like Forex swaps and these kind of complicated transactions. So the amount of transactions going through in the Forex market is not transparent. The average person cannot sit there and try to follow all the trades going through. Now, all of this information is important. I at least believe that this is important information. When you bring up a time and sales for this particular market, what you're seeing is real trades. These are real transactions that are going through currently in the market. But these are only the trades that are going through on Interactive Brokers Ideal Pro exchange. Therefore, as I just finished telling you, we're missing a lot of real information about what's actually going on in this marketplace. We're only seeing the trades going through in Interactive Brokers, which in my opinion is not enough information into the market. We're not actually seeing how many sold, how many bought. I'll try and give a simplified example because I know everybody trades in a different way. Let's say the market is going up and you're betting that it's going to keep going up. You think it's going to keep going up for whatever your criteria is, reasons X, Y, and Z, because everybody trades a little bit differently. Okay, so you think the market's going up, it is going up. Now, the difference between you seeing all the liquidity versus only seeing some of it can make a big difference into how you decide to execute that trade. So let's say you're looking at the order book like this. Okay, so we can see, I'm going to maximize it. We can see here that this is the current bid, which is 1.31560, and the current offer is 1.31575. Now, one thing you might notice is that they're 5 tick increments, and I'm going to mention something about that as the video continues here. This is regarding the spread that you pay when you enter a trade, which is very important. Stick around for that part of the video because it's very important and it plays into the overall expectancy of your trading over a very long period of time. By the way, if you're enjoying this video, press that like button and subscribe and share it with a friend. Let's say, like I said, you're betting the market's going to go up and your criteria is lining up. Now, if you had access to all the liquidity in the world, you could see how many are really bidding the market up. Whereas if you only had a quarter of the information, you might see a bid over here of 1 million or 10 million or even 100 million. And because that's only like maybe 1% of the actual information, 1% of the actual bids that are probably there in the market, that 1 million, that 10 million that's sitting on the bid at this price over here, it means absolutely nothing. You place a bid over here at this price. I want to buy it at 131,565. Okay, you can see right now there's 3 million on that bid. This is only on the liquidity pool of Interactive Brokers. Now, the main problem with that is that because this is only the volume you're seeing on one exchange, that information has absolutely very little significance to the actual amount of demand that there might be at that price or supply. If you see a bid at this price of say 100 million or 200 million, and the market continues to trade at that price, you see sellers that continue to sell at the price that you want to buy, and that big bid of 100 million, it never lets go and it continues reloading with another 100 million, another 100, another 100 every time. And then eventually the market goes for an uptick to the next price. Well, that gives you a good signal that there are people willing to support the price and continue to push the market up to see how far it can go on the upside. It informs you that there also are other participants that are willing to buy on that bid and just sit on that bid and absorb all the sell orders. So the main point behind all this is that you're not seeing truly the amount of demand that there is in the market supporting you if you want to buy it, and you're not seeing how much supply there is in the market if you want to be a seller. So you don't see how many traders are actually there backing you up or trading against you. So you're missing a lot of information. So now I'm going to talk to you guys about spreads and what is a spread and why the spread is important. So if we take a brief look at this order book, you can see that it's in 5 tick increments. In Forex, sometimes they use the term pips. A pip or a tick is basically the minimum price increment of the market. Now here on this, you can see it's 5 tick increments. But if we take a look at the time and sales window that I opened not long ago, you will notice there's in between ticks that are going through here that the retail traders trading the market don't have access to. So again, you can just see it by the amount of decimal places that there are. So 1.315505, whereas here you're seeing 1.31555. And also, if you place an order on the currency pair, you will also only have access to that amount of decimal points, meaning that there's in between orders there that individual retail customers are not able to access. You're not able to access the in-between prices. Now, what that means, I'll tell you what that means, is that whoever is employed as the official liquidity provider or market maker for this Forex exchange is able to profit from the retail customers that are placing their orders. They're able to constantly pick up those in-between ticks in between. So if I'm a liquidity provider for this exchange, I'm offering it out at 31,560 here. And let's say they're trading with me. I have the opportunity to instantly flip that at any price in between 560 and 550 in this case, because what you're seeing here, the spread you're seeing is not the actual spread of the actual best bid and best offer in the entire Forex market. What you're seeing is the best bid and best offer on this exchange, meaning that the people who are employed to provide liquidity to retail customers on this exchange, the big boys who are sitting there providing these bids and offers, they are able to instantly flip the trades that they get from the retail customers and instantly flip them for a profit every single time. So these market makers, what they're intending to do is whenever they're trading with a retail participant, before they execute the order, they make sure that they can instantly flip that order either for a small profit or for a break, even if it's some sort of an emergency or something. But most of the time, they flip it for a small profit, and they're constantly flipping these trades back and forth all day long. And that's what goes on, I'm pretty sure, on 90%, if not all, of retail Forex exchanges, where you don't really have access to trading on the actual spread. Now, while you might be able to put a bid, for example, I can place a bid here at 1.31545, and I might be able to be filled on that, even if it stays bid, meaning I was filled on the bid, I still do not have access to the in-between ticks between 540 and 545, or 545 and 550. The broker or the liquidity providers that own this exchange are not allowing the retail customers to gain access to those in-between ticks. So you're paying that spread every single time. That's a disadvantage. It means you can't be as nimble when you're getting in and out of your trade. And in order for you to get in and out of your trades, you need the liquidity providers, the people who run the exchange, to fill your order, to make sure it's okay for your order to be filled. meaning that if they can make a small profit off your trade, they're going to let you trade. If they can't, meaning the market's one-sided and it's moving in one direction and you're trying to get out, you're going to be stuck and you're going to get filled at a little bit of a worse price. And that's called a market order slippage. So if you have a market sell order and the market is moving down very fast, let's say your sell stop order was at 1.31535, it's going to probably get triggered at 1.3153 even. And again, every exchange might be a little bit different. Market orders are most of the time going to slip by a tick. And because the minimum tick increment in this market is 5 pips, when in reality, they're kind of skimming you on the other 4, you're technically getting slipped. If you use a market order, you're always going to be slipping those 5 extra pips. And over time, the 5 pips, on some exchanges, it might be even worse. That's going to add up, trust me. And you might think it's small. You might say, oh, I go for bigger picture trades. Sure, maybe you do. But trust me, look over 1,000 trades and see how those 5 pips or 10 pips, whatever it is, see how that adds up. And you're going to see at the end of the year how much that adds up to. I would encourage you guys to find markets that, number one, have more centralized volume. And I know this is kind of not easy to find in electronic markets. There's always all kinds of volume going through in different places because we have derivatives like futures and options contracts. And even in the stock market, while we have our 3 major networks, the NASDAQ, the ARCA, and the NYSE, there's dark pools and other exchanges and liquidity pools that brokers can trade with one another, and big institutional customers can do business without the general public seeing all the trades. I don't think that that's really a bad thing, but it does remove some transparency from the overall market. But I would say the transparency in stocks and in futures is a lot higher than it is in Forex, simply because Forex is so widespread across probably thousands of different institutions across the world, transacting trillions of dollars. So you're really not seeing what's going on. You're not seeing how many sold, how many bought, and what price and what time, and how many want to buy. You're not seeing any of that information, my friends. All right, that's going to cut it for this video, my friends. I hope you enjoyed it. I hope it provided some value to you. And check out this video right here to learn about the trading platforms that I use for trading. And then check out this playlist to learn about some other trading knowledge that I think could help you in the future. Thank you for watching.